Let's talk about security market line. That's slopey line that we get a graph of beta coefficients against the expected returns. Having established ourselves already in capital asset pricing model, then what does this actually symbolize? That is what we want to look at, really, the capital security market line, which is this slope. First of all, we need to establish one thing, that the security market line actually is measuring the performance of the risk. It starts from the risk-free rate, so and slope upward. So this point is our risk-free RF. Our risk-free rate is here. So, and that means the lowest risk in the market. So that is why you could see that our beta is at the 0 point. Meanwhile, we have our expected return RE as high as this. So it could have been any percentage anyway. We are going to get that to that stage. So when we plot beta coefficients against our expected return, we will have definitely at a point what we know and regard as security market line, which is this. On the practical notes now, for Capm, we will talk about the beta coefficient, which ordinarily should be equal to 1. So let's say we have 1 here. If this is our 1, so that is the market risk, total market risk. Now is 1, and we will see that is above the risk-free rate region, which is very okay. Then when we have a beta for any stock that is a bit higher than that of the general market, let's say we have 1.5 for any reason, we have a beta for a stock we want to buy having 1.5, and the return to, let's say, 1.5, let it be somewhere around here, 1.5 too. Then we plot them against one another. Okay, somewhere I will have to adjust the beta coefficient, but just for illustration purposes. So when we have a graph like this, anyone that exceeds the equals to 1, we will say that they are actually aggressive stock. So this in this region now represent those stock that are aggressive. That is, they move in higher proportion than the overall market's responsiveness. Okay, so now we could equally have those that are under. We said they are defensive stock. Let's say 0.5, those that are lower than the capital market risk, that is beta coefficient. Then we can plot them, say they are lower, and we try and match it somewhere. So basically what SML, security market line, actually is the reward that the investor will get for the risk they have taken, either above or below. And for this one now, that is almost below the risk-free rate, is better for an investor like this to have gone for bond. I hope you agree, rather than, because the risk-free rate is even higher now. So if we had gone to for risk-free rate, it could have been better been better off because the risk and the return is a bit lower. It hardly really happen, but it could happen. This is just an example as we talk about security markets line. So it's a visual representation of the risk plotted against the return. It is usually an upward slope line, which we always get when we plot security data against expected return of a security. So it's a visual representation of Capm, and it tells us the reward that an individual will get having